Would you like to learn how to use an option trading strategy for hedging a core position? Hi, I'm Larry Gaines, Power Cycle Trading, and in this video I'm going to show you how to use call options to sell call options to hedge a call debit spread. So in this trade setup, this is Lockheed Martin, and this is a setup where we did a trade, set up a long call debit spread, and set this up on the 19th, which was on Wednesday for a long, actually on the 20th right here for a long trade setup. So this is what we call a volatility squeeze. Had a trend line break, we had a cycle reversal. You can see the signal here. We had momentum up, and the best entry would have been right here on the 18th, but we did a setup here looking for this to trigger further to the upside and looking for a break to right here, this prior high, this Fibonacci level, and looking then for it to move up to the 1272 extension right here. So target around, basically we're looking for 110 to up here to 111. So the initial trade was just doing a call debit spread, the 307.5, 310 for the 9/29 expiration, which is next Friday. But with today, with the Fed meeting from yesterday, the market's kind of stalled here. So one way to hedge this position to reduce the risk was either to convert it to a butterfly or to convert it to what we call a call condor. So I'll show you the trade setup here. First off though, let me just pull up the option chain. So the trade setup that was initially done was buying the 307.5, 310 vertical call debit spread, 929 series, at 99 cents or $99 per spread. So you've got at risk maximum $99 and potentially $151 profit if it was to expire at 310 or higher next Friday the 29th. So basically, it stalled out, so that trade right now is going at around $1.25. So still really good potential upside, but in order to reduce this risk from $99 or 99 cents lower, we sold a bear call credit spread. So sold the 312.5, 315 bear call credit spread and sold that at 40 cents credit. Okay, so that's the credit spread, what it looks like here. Short the 312.5, long the 315, $2.5 wide. So when you add that to the debit spread, that creates this structure, this risk profile, and this is what we call a condor. So we're long the call debit spread here, the 307.5, 310, and then short the 312.5, 305. And for next week, if it goes out anywhere in between here from call it 309 to 311, 313 in that range, this will make over $150, and theoretically it can make 190. So it's a really great way to reduce risk, and then we can also add additional layers to it. So just a nice hedging strategy using what we call the call condor.